Did you know that one simple tax rule could let you pocket up to $500,000 completely tax-free when you sell your home? If you're a homeowner over 55, wondering how to protect your biggest asset from Uncle Sam as retirement approaches, stick around, because today's video reveals 4 powerful tax strategies that could save you tens of thousands or more and secure your financial future without the usual headaches. Hit that subscribe button right now and turn on notifications so you never miss these game-changing money tips for seniors. And drop a comment below telling me whether you're planning to sell your home soon, age in place, or explore equity options. I read every single one and love hearing from you. Let's jump straight in. Your home isn't just where you live. It's likely your largest pile of wealth after years of mortgage payments and rising property values. But tapping into that equity, or simply staying put, comes with a maze of tax rules that can either boost your retirement or create nasty surprises if you're not careful. The great news is you have far more control than most people realize, and by understanding a few key strategies, you can make smarter decisions, whether you're eyeing a sale, planning to remain in your beloved house for decades more, or considering ways to access cash without moving out. We'll cover 4 essential pillars, starting with the absolute powerhouse for sellers, then moves to incentives for aging comfortably at home, clears up myths around reverse mortgages, and wraps with a newer senior deduction that many overlook but could seriously move the needle on your taxes. First and foremost comes the Section 121 exclusion, hands down one of the most generous breaks in the entire tax code and a true cornerstone for anyone thinking about selling their primary residence. As a single filer, you can exclude up to $250,000 of capital gain profit from your taxable income when you sell, meaning that chunk of money vanishes from the IRS's view entirely. It's not just deducted, it's as if it never happened on your return. For married couples filing jointly, that limit doubles to an incredible $500,000. So picture this. After decades of appreciation, you sell for a huge profit and potentially walk away owing 0 federal capital gains tax on up to $500,000, which can become the rock-solid foundation of your retirement nest egg. To qualify, you generally need to have owned the home for at least 2 of the 5 years before the sale and lived in it as your primary residence for at least 2 of those 5 years. Only one spouse needs to meet the ownership part for the full joint exclusion, but both typically need to satisfy the use requirement. Life throws curveballs, though, and the rules offer real flexibility. A surviving spouse often gets a 2-year grace period after losing their partner to still claim the full $500,000 exclusion. People forced to relocate for serious health reasons can sometimes receive a prorated partial exclusion even if they haven't hit the full 2 years. And seniors moving into a licensed nursing home or assisted living facility only need to have used the home for 1 of the prior 5 years to still qualify. Getting this right can literally save you a fortune, so if selling is on your radar, make sure you track those timelines carefully. But what if your dream is to stay right where you are and age comfortably in the house you love? That's where the second major strategy shines: tax deductions for home modifications that make your property safer and more accessible. If you itemize your deductions, you can claim qualifying medical expenses that exceed 7.5% of your adjusted gross income. So for instance, with an AGI of $60,000, you'd start deducting once your total medical costs top $4,500 for the year. Home improvements made primarily for medical necessity count toward that category. And the best part is that certain accessibility upgrades don't increase your home's value in the IRS's eyes, allowing you to deduct the full cost rather than just a portion. Think installing grab bars in the bathroom, building wheelchair ramps, widening doorways for easier mobility, adding stair lifts, or lowering countertops. These are treated as deductible medical expenses because they're directly tied to health and safety without boosting resale value. For larger projects that do add value, like an elevator or a therapeutic pool, the deduction gets adjusted. You subtract the amount the improvement increases your home's fair market value from the total cost, then deduct the remainder as a medical expense. Planning these changes thoughtfully not only improves your daily quality of life, but can also deliver meaningful tax relief if your overall medical spending crosses that AGI threshold. Next, we need to tackle the frequent confusion surrounding reverse mortgages, because the tax reality might surprise you and could influence whether this option fits your plan.
Unlike traditional loans, where interest might be deductible under certain conditions, the interest on a reverse mortgage is generally not deductible until you actually pay it, often when the loan is repaid after you sell the home or pass away. However, the money you receive through a reverse mortgage, whether as a lump sum, monthly payments, or a line of credit, is typically considered non-taxable loan proceeds rather than income, so it won't push you into a higher tax bracket or affect Social Security taxation in most cases. That said, it's crucial to understand potential impacts on things like property taxes, insurance, and estate planning, plus any fees or compounding interest that build over time. Many seniors use reverse mortgages successfully to supplement retirement cash flow while staying in their home, but it's not a one-size-fits-all solution. Consulting a trusted financial advisor helps ensure it aligns with your overall goals without unintended tax or long-term consequences. Finally, let's talk about an often overlooked but potentially transformative deduction that has gained traction for seniors: the ability to claim certain home-related expenses or energy-efficient upgrades under evolving rules, though one newer avenue many are excited about involves expanded credits for accessibility and health-related improvements that sometimes overlap with medical deductions or stand alone as energy or senior-specific benefits. While details can shift with legislation, keeping an eye on IRS guidance for qualified improvements can unlock extra savings, especially if you're combining modifications with other credits. The key takeaway across all these strategies is proactive planning, whether maximizing that massive Section 121 exclusion, deducting accessibility upgrades to age in place, understanding reverse mortgage tax treatment, or exploring emerging senior deductions. You hold more power than you might think to shield your home equity from unnecessary taxes and turn your property into a true retirement ally. If any of this resonated with you, smash that like button to help spread these tips to more homeowners. Subscribe for weekly videos breaking down retirement taxes, Social Security, and estate planning in plain English, and comment below with your biggest question about home taxes or which strategy you're most interested in exploring next. I personally reply to as many as I can. Thanks so much for watching. Take care of that valuable home of yours, and I'll see you in the next video.